Okay, so we're looking at the components of aggregate demand. And we said that aggregate demand, which is total demand for goods and services in a country, so in the UK, total demand for UK firms' goods and services, is equal to consumption, plus investment, plus government spending, plus exports, and then subtracting any money that's spent abroad. And we looked at consumption. So what we're going to turn to now is the second component of aggregate demand, investment. And this is one of those terms that kind of newspapers have as meaning one thing and economists have as meaning another. So when people see investment, they kind of think of people buying shares. I've got my investment portfolio and so on. But that's not what economists mean by investment. So we're not talking about financial investment. We're not talking about shares. We're talking about private businesses, generally speaking, adding new kind of fixed capital. So if you look for investment in some sort of statistical database, you're often looking for something called gross fixed capital formation. Now, this isn't the only thing that we might count as investment, but gross meaning total, fixed capital meaning generally machinery, so capital that is fixed, and formation meaning creation. So investment is the creation, in total, of new fixed capital, new machinery. Now, investment might mean more than that, but your starting point, when you're thinking about investment, is to kind of think of a new office, a new factory, new computer equipment, that type of stuff. So investment, classically, there's kind of physical capital formation. So that's kind of buildings, machinery, IT, that type of stuff. We might also add investment in human capital, which would be training, and investment in kind of technological capital, or ideas, which would then be R&D. And they're all investment, but particularly at the start, when you're thinking thinking about talking investment, think about a new IT system. Think about a new head office. That's the sort of thing that we're talking about. When we mean investment. So, like with consumption, investment varies a lot by different countries, depending on their industrial base. So what sort of industries, what sort of sectors they have, and depending on what stage they are in economic development. So China, which is growing incredibly rapidly, we've talked about before. China, 45% of its GDP is investment. Some of it's by the government, some of it by private sector firms, but it's really, really high. Whereas in the UK, only 15% of GDP is investment. So per pound, per unit of GDP, China is investing 3 times as much. So does that matter? Why do we care about investment? And when we say we care about investment for 3 or 4 main reasons. The obvious reason, is that investment it's a component of aggregate demand. And therefore, if firms are investing, whether they're local firms or foreign firms coming in doing FDI, foreign direct investment, that investment literally creates jobs. You can't have a new head office unless somebody builds it. So if I invest and say I want to, suppose with Dover Brooks we want to invest, we say we want a new art studio, somebody has to build it. Our investment creates demand for private sector firms. If we want a new IT system, then I'm sure Microsoft will be very happy. So investing, creates demand, and therefore it creates jobs. It's part of, as we said, aggregate demand. So hence it leads to actual growth. And that's been, in China, that's been a major part of their actual growth over the last 20 or 30 years. Less important in the UK, but important nevertheless. Secondly, there's the obvious point, that it's going to, it's clearly going to affect, potential growth as well. We said that our production possibility frontier it depends on the quantity and the quality, particularly, and the efficiency of use, but here the quantity and quality of facts of production. Well, that's what investment does. It creates new factors of production, so we have more factors, and obviously, presumably, these new factors of production are going to be higher quality as well. So therefore, it's expanding the potential of the economy. So it's creating both actual and potential growth. So that sounds good. Thirdly, it's also going to affect productivity. Now, productivity is generally measured as output per worker. So it's not production, it's efficiency. Now, probably an increase in productivity will lead to an increase in production, but it doesn't necessarily have to do so. Suppose I have 10 workers and I make them twice as productive, twice as efficient. It's not necessarily the case that output's going to double. I might make the same output and just fire half of them. But what it does mean is it's going to reduce my costs. I can make the same output, of goods or services more quickly. Therefore my unit cost is lower. Therefore that's going to improve my competitiveness on world markets. So hence, again, investment is valuable for businesses, because it helps them to be more effective when they're competing. And fourthly, you might say that investment is important, in some countries, to get access to natural resources. So in a lot of developing countries, often there are plentiful natural resources, but they can't access them because there's a lack of funding to create the investment into infrastructure and capital to extract these resources and to be able to sell them. So that's a fourth reason that you might think that investment is important. So therefore, investment is an important component of aggregate demand. Yes, it drives demand itself, it creates potential, it helps firms inside the economy to be able to compete on world markets, and to be efficient.